Yeah, so we're in the fortunate position that we didn't really get cut back on our allocation to private equity this year. And so I was given instructions to deploy carefully. So I'm responsible, Allstate is a large general insurance company listed in the US. We're largely investing balance sheet capital, and the profile of our payments over time is related to insurance claims in US dollars. And so what they didn't want for me as the non-US allocation was for me to be overweight if we got cut back in later in the year, which we didn't. So I've been focused on very steady deployment and with roughly the same figures as we invested last year. What I can see through our portfolio for distributions for this year is that they are very significantly down. I think that's the same for everybody, and that's unsurprising. So I don't know what that means at this point for allocations to be invested for next year. And I think, obviously a lot of the pension funds have had very significant denominator effect. Having said that, public market valuations have broadly improved. And so I don't know what position that leaves them in, but I think we are all impacted by the lower distributions, and for us, all I can say is it's yet to be seen what our deployment targets will look like in private markets for next year. In reading that question, I wouldn't, and having been around long enough that I came through the financial crisis in 2008, I wouldn't characterize this as a liquidity crunch. But I suppose that's more from a credit perspective. The sort of system seized up after the financial crisis in terms of lending. I'd say it's more difficult to get things financed at the moment. On the debt side, the standards of partner fit and the underlying quality of the business is held to a higher standard. Deal volumes are down, obviously, as we were just talking about. A lot of LPs have been in the position where they've had less capital to deploy, more to commit to funds and to co-investments. So there's been less money around, but I wouldn't call it necessarily a liquidity crunch. What I've been hearing a lot is, flat is the new up. So, so allocations through 21, and, a lot of people were giving indications, we want more, in the next fund, and the ticket sizes were, in some cases going up where people had really high conviction relationships, and those managers were coming back into the market to raise new funds. I think at the beginning of last year, what I observed more generally is that, flat was the new up, and going forward, I don't see that being any different. And I think now LPs have the opportunity to be, we were being told for some of the really high quality managers, more specifically as I see it, in Europe and the US, being told, look, you have to get your work done quickly, and otherwise, we're going to be done with our fundraise in 8 weeks or whatever it is, and you need to get your work done quickly so that we can reserve you allocation. So that is not the case now. So there's a lot more option for us to have time to consider things carefully, and I suppose that puts some people in the position where they can make more high conviction picks. Maybe that means some people are looking to rationalize relationships and allocate more to their high conviction relationships, but I think I would assume not actually, given the impact more broadly of denominator effect. Now, Middle Eastern investors, I think that's a very different ballgame, because they don't, they've kind of, as I understand it, their allocations are more directly impacted by oil price. But certainly coming through last year, they had, on that basis, you would imagine the opposite of denominator effect, some of them. And our ticket sizes, all I can say, really definitively commented on is us, and ours are probably very slightly more, smaller, but not really. It's, broadly same. everything else I've looked at, it's taking a lot more time, even really high quality managers who usually do have processes that are done, you know, in a matter of weeks or a couple of months, you know, and have on that basis very high quality track records. It's very difficult, and I'd say with Asia in particular at the moment, China, as it relates to Western LPs, you know, they've got a number of different factors that are impacting the way that we, you know, the geopolitics and some of the impact of some of the regulatory changes that have been happening. I think for some of us that was unexpected, and so I would imagine if you ask the Chinese GPs, their fundraising process are you know, very significantly slower.
Then if you just look ahead a little bit, you spoke about it already a little bit, but what do you think will be some of the biggest trends and topics the industry will focus on as we go into 2024 soon?
You know, I think that people are, you know, the global macro, and also geopolitical factors are a lot more volatile than they have been in the past. So I think, you know, to some extent, and you know, having said that, I view private equity very much as a micro game. So, you know, we've got some really high quality managers that, you know, particularly in Europe, that I have every conviction that they'll see this as a really good opportunity to get things at a better price, and, you know, apply a very particular playbook to still generate, frankly, some really, you know, I'm very high conviction that some phenomenal returns will come out of this scenario, because, you know, even with interest rate spreads having gone up and the cost of borrowing being significantly higher, the pricing of some of these assets on the way in at the moment is, you know, getting to the point where it's a lot more attractive certainly than it was in 2021. But, you know, so people, to come back to your question, I think people will be considering the macro very carefully and how their strategy fits in the context of what's going to happen in their individual markets. I think that people are going to be mindful of the geopolitical, and, you know, they'll be sort of thoughtful how that might impact their allocations on a geographical basis. I think that the other things that continue to be important are, I think, you know, we're seeing to some extent a deglobalization. So, and so there will be, with any level of change, that will drive some opportunities that people will focus on. I think people are sort of quite thoughtful of, you know, regarding how conflicts of interest are managed with the larger GP secondaries. And so, you know, I think with GP secondaries in an illiquid market, it's always good to have additional sources of capital that are able to provide liquidity events to those who want to come out of transactions, especially, or deals, especially given that distributions are down at the moment. So I think that's positive. But, you know, I sit on the ILPA board, and we recently had a GP LP summit both in London, which I attended, and there was also one in New York. And LPs remain very mindful of appropriate management of conflicts of interest in the context of GP-led secondaries. And the other thing that people were talking about in that forum is about fund level financing and how that is managed, NAV facilities, and you know, I think some LPs like to see fund level leverage as it drives better IRRs. But, you know, in the current interest rate environment where such facilities are expensive, and, you know, some would argue, you know, the leverage might introduce additional layers of risk, especially as it relates to the NAV financing. I think that remains a topical issue as well.